Welcome to Crazy Shit in Real Estate, a weekly podcast where I walk you through some of the wildest, most unbelievable stories you'll hear from the world of real estate. If you like real estate and you love crazy, this is the podcast for you. Before we get any further into this episode, I've got some information to share.
Oh, it's true. Real estate is super competitive and harder than you expected. That's why I created Leigh Brown University. It's everything you need to take you from point A to point whatever your goal is. You could be new to the business or a seasoned vet. I'll help you break through to the next level so that your professional life can look exactly like you desire. Enroll in Leigh Brown University today. I'll help you get there.
They're very used to hearing about investors, but we've never had anybody on here to talk about mortgage notes outside of like an actual regular lender who does typical mortgages and refinances. So give us a quick explanation of what it is that you do. And remember, in my audience is not just real estate professionals, it's also regular people who kind of dig getting the inside scoop on lots of angles of real estate. So you've got some normal people out there too.
You're saying real estate people are weird.
Absolutely, they are. These people work 24 hours a day, and then they simultaneously love it and hate it, and they get paid sometimes, and sometimes they don't get paid, and they get screamed at and cussed at and hugged all in the same afternoon. I mean, you kind of have to be crazy to live in real estate.
Yeah. And as long as getting paid is in there some way, right? You learn to tolerate it. But so I don't do anything on the origination side. I buy mortgages from the secondary mortgage market space. So there's literally a flea market beyond the origination point whereby hedge funds and other lenders buy and sell mortgages. And I do that to the tune of millions of dollars, both on the performing mortgage and non-performing side. So I'm a large consumer of purchasing non-performing mortgage loans and getting those mortgage loans to perform as a profession.
All right, so tell us what it means to be non-performing.
So essentially the borrower is in default beyond 90 days. But
look, Martin is so nice, y'all. He's saying they ain't paying. Go ahead.
But generally we're talking 4 or 5 years they haven't been paying. So
did you say years?
Yeah, years.
All right. So how does it carry on that long when I've had clients who have hit hard times and after 3 months, they're getting demand letters. How does it last that long besides the person who heard about filing for bankruptcy as a solution?
Sure. So it's actually more common than you think. There is a large body of these mortgage loans that have sat on bank books for many years. Most of them were originated sometime in the 2000s. Early 2000s, and they've been in default 4 or 5 years. And the bank at some point, after internal charging off and doing other tactics internally, they'll go and pull them into a tranche and sell them into the secondary mortgage market space. So that's where a company like mine purchases them. But with smaller banks, they're usually, going to go and send the demand letter out, and they're going to pay a little bit more attention to defaulted paper. But banks like Wells Fargo, PNC, and the larger guys, they could take a little longer to get through the process.
All right, so it's like buying a box lot of Barbie dolls on eBay where you've got 50 dolls in the box, and there might be 2 good ones that the hair's not a mess, and there's going to be some without heads and some without legs and some you can play with and some that should be thrown away. Is that basically what your tranche is? It's a lot of mess and you don't really know what you're buying?
Well, you very much have a sense of what you're buying before you're buying. The fact that the mortgage loans are considered scratch and dent, that's without saying. The bank is
I love scratch and dent. That's the best way to get a refrigerator.
Because there's a value add, right? That's real estate, 101. So, when you're buying something at par and the coupon rate's at 6%, then you're not going to get wealthy off of that. It's when there's, you're buying something at 30 cents on the dollar and you can get it performing at par. That's when you can do well as a business.
All right. So you get it performing. That means you go knock on doors and get people to start paying their bills again?
Yeah, it's a little bit more to that. I mean, we work with a licensed servicer. We have a team of asset managers that work for me and in my department. And so, we're very compassionate, bunch of individuals. We consider the borrowers as customers and we treat them like gold. So we actually cultivate deep-rooted relationships with the homeowners so that we can not only create payment plans that they can afford, but we can be first in mind when it comes to making payments.
Oh, you're enjoying this little clip? Well, the rest of the story is available on any of your podcast apps. Just go search for and subscribe to Crazy Shit in Real Estate with Leigh Brown.